Bitcoin is now just beginning to come into its prime. And every time a new Lightning wallet is shipped, Bitcoin is upgraded. And every time a new layer 3 app is created, Bitcoin is upgraded. And Bitcoin is the opposite of that. Whereas commercial real estate peaked, as for when it peaked at different points in different jurisdictions over the last 100 years. Bitcoin is now just beginning to come into its prime. And every time a new Lightning wallet is shipped, Bitcoin is upgraded. And every time a new layer 3 app is created, Bitcoin is upgraded. And every time a new miner comes online, Bitcoin is upgraded. And every time a new regulatory guideline is laid out, Bitcoin is upgraded. So Bitcoin is just continuing to improve its property. Real estate is continuing to decay its property. If we come back to your question, how does this get demonetized? Well, you can see that the only reason that a casual investor wouldn't start to shift their allocation of savings from commercial real estate to Bitcoin is they don't understand Bitcoin, right? Most of them, if you walked up to the typical real estate investor and say, quick, give me the 18 crippling defects in your real estate, they couldn't name the 18 things I just laid out to you. And you know what? I couldn't either before I knew Bitcoin. You don't understand the defects in your property until you see perfect synthetic property or digital property. Just like you don't understand the defects in your currency until you see perfect currency. If you don't understand Bitcoin, you don't know what's wrong with gold, right? And you don't understand what's wrong with fiat currency, really, until you understand what's right about Bitcoin. And I think the same is true with property holders. They don't understand what's wrong with their investment until they understand what perfection looks like. And most of them, when they hear Bitcoin, they just are afraid. Their reaction is just, oh, it's scary. I'm afraid. I don't know much about it. It's too volatile. And their brain shuts off. And that's like as far as it goes. So as we educate the population on Bitcoin, I think people start to create tables of the 10 defects in real estate versus Bitcoin. And then you go, wow, the only thing not to like about Bitcoin is it's new and volatile, right? And once you understand it's new and volatile, well, what is the negative? Oftentimes people have managed to not mark their real estate to market. If you can avoid a mark-to-market loan on real estate, then you're in good shape. Any big property development family that went bankrupt, they normally went bankrupt because their real estate assets got marked down and their loans got called by the bank. So it's that volatility which is the number one risk. And as Bitcoin's volatility decreases over time, the loan to value ratio that you could incur if you're acquiring Bitcoin will start to advance. Right now it's a low loan to value, but it will grow as the volatility deteriorates. And as I've illustrated, even in commercial real estate, there still is some volatility and there are still some mark-to-market loan defaults sometimes. But having said all that, that doesn't, whether or not the asset is volatile, doesn't change all the other strategies with regard to real estate investment. If your only strategy is I wanted to borrow money to buy real estate, well, then you're going to lean toward non-volatile traditional assets that your bank won't remark every day. But if you're using debt to make the investment, if in fact you were holding $2 million in cash right now, and your choice is, do I actually put it into Bitcoin or do I put it into something else, right? Then it's a slightly different calculation. So I think that education will cause people to gradually demonetize their real estate and move it into Bitcoin. I think if we switch subjects to the second question you had, which is how, how does it impact equity? Well, the most vulnerable equity is the equity indexes, like the S&P index, or like some broad index of the Russell 2000 or the S&P 500 or the NASDAQ index. Those are things that people buy just to have a store of value without expressing an opinion on a given company. Like I don't want to pick which of the 500 S&P 500 companies is undervalued. I just want to park my money somewhere. So I think Bitcoin there is emerging as the monetary index, or a monetary index that you can acquire, and you just don't have to express an opinion about a commercial entity. You don't have to be worried about the quality of the management team or the cash flows or regulatory concerns. And so it will tend to demonetize those indexes. And as those indexes get demonetized, if $1 billion gets pulled out of the S&P index and put into Bitcoin, then that's $1 billion of demand for stocks of the underlying 500 companies in the S&P that goes away. So as the money gets pulled out of the indexes and the ETFs, then that will demonetize the equities of the underlying constituents. And as that happens, if one of the constituents is undervalued on a standalone basis, then a professional investor will come in and they will buy that stock in order to arbitrage the difference. And so I think that that's the dynamic there. Well, I mean, it strikes me that if you look at gold, at least half of the value of gold is the monetary premium. So when gold trades at $1,600 an ounce, maybe, the cost to pull it out of the ground is $800 an ounce. And so, and there's more demand for it than there should be. So if you cut the demand in half, then the marginal cost for the cheapest amount of gold would probably go to $600 or $500 an ounce. So reasonable to think that 2/3 of the value of gold is monetary premium. And if people just limited their gold demand to what they want to wear, then you would see a gold price which is half to 1/3 of what it is right now, and the remaining monetary premium would flow into digital gold, which is Bitcoin in this case. So there's $5, $6, $7 trillion of gold's monetary premium to be grabbed by Bitcoin. But I think if you if you look at the world, I know lots of people, lots of rich investors that will hold a 10, 20, 30, $50 million real estate portfolio that would never think about holding 50 million in gold, right? So I think that there's probably 10x the amount of monetary premium in real estate that there is in gold. And if you look at the monetary premium sitting between, real estate and equity, one would think that, you're starting to approach $100 trillion number there. And so all of that is the truly great, the great waste of capital, or the great capital sinks in the world, are all of the money trapped in bonds, trapped in equity indexes, and trapped in overvalued real estate. To a lesser extent, currencies, but I really think the bonds, the real estate, and the equity, and probably the bonds and the bonds are the biggest, the real estate's the second biggest, the equity is the third biggest, but all of them are an order of magnitude more than the capital that's been trapped in the gold asset. So $100 to $200 trillion, right, is kind of trapped there, depending on how you look at it. And, you can work backwards to try to figure out what that means to Bitcoin.